All right, here we go. It's just after 9:30, and that means the markets are now open. Market's down just a little bit, but I suspect things may change in the not-too-distant future. Investors are now awaiting the Federal Reserve's latest policy decision, and for the first time in 4 years, the Fed is expected to cut interest rates at its meeting today. The Fed has held rates steady since its July meeting last year. But last month, Fed Chair Jerome Powell said the time has come for a policy adjustment, if you will. Right now, the federal fund rate stands at a range of 5.25% to 5.5%. That is the highest in 23 years. The CBS News contributor Javier David is joining me now here in Studio 57 with a preview of today's Fed rate decision. So the general consensus is a cut is coming. It's just how big is it going to be?
In 25, 50, it's a complete toss-up at this point. So CNBC aptly describes it as this action-packed meeting. This is going to be the first time in years we're actually getting a rate cut. If you believe that the Federal Reserve is behind the curve, they should have loosened monetary policy sooner, then you're probably doing what some in the market are doing, which is pricing in a 0.5 percentage point cut. My own personal gut, this is my personal feeling, it's going to be 25, but one of those who's on the other side of this argument is billionaire investor Jeff Gundlach, very savvy guy who's made way more than either of us could ever see in our lifetime, several lifetimes. He thinks a recession is imminent, and he feels like the Fed has been asleep at the switch. But the unbiased take is, look, you had the retail sales data yesterday. You had manufacturing output. Those were stronger than expected. Despite the softening in the jobs market, it just doesn't reflect an economy that's sort of on the cusp of recession or in crisis or at all. Again, my gut says 25, especially in the wake of that data. But thank goodness for the indefatigable U.S. consumer. They continue to spend. They keep us
do
floating.
My best,
We all do. Yeah, well, so do I. So we're promoting our companies, our country. So there's a case for monetary policy, though. I should say this, that being most effective with the element of surprise. So it's like go big or go home. So the Fed could come with 50 basis points, but it's more than likely to sort of do the down payment. Here's 25. We're going to sort this out over the course of the next year. Definitely by the end of the year. There's always November. There's always December. Everyone calm down.
We don't have to get
it. Yeah, we can get there slowly.
Yeah. I'm with you. I feel like Jerome Powell is he's very measured, and he really he's not one to surprise. He telegraphs where he's going.
Exactly.
So then what will this mean for Americans? Even if it's a 0.25 percentage point, that's got to be good.
It's good. It means all the things that we pay interest on, credit cards, mortgages, personal loans, we're about to get a modicum of relief. And it's a small sort of token measure. But the best thing the Fed can do right now is indicate this is the first stop on a path to gradually lower rates over the course of the next year. That means that, over a set period of time, we're going to get much more substantial relief and see that in, the form of your lower APR. If you're looking for a car, I actually just spoke to a friend last night who said he was out shopping for a car that he had, to replace. He had an accident about a year or so ago. Just complete sticker shock. It's not affordable.
Really?
And used car prices have come down substantially because you remember during
they were going bonkers during the pandemic.
Absolutely. And that's come off sharply. But it's really the APR that people are just kind of you look at it and you're trying to war game exactly how much you're going to pay every month. It's up there. And those are in double digits. And as much as we talk about mortgages being 6-7%, auto loans are 17, 18, depending where you get it and what your credit score is and all of those other good things.
So you touched a little bit on this, what Jerome Powell will be looking at, what sort of metrics he'll be looking at. And we should point out that, I feel like a lot of the recent reports that people freaked out about kind of later on were adjusted and everyone kind of rethought their overreaction.
Yes. So there's a range of things that they look at. And the first is the personal consumption expenditure data. That's their preferred gauge of inflation. Last read we got was a few weeks ago, showed a monthly gain of 2%. As expected, not catastrophic, but just kind of reminds us that prices are still rising. And I think this is why Business Insider had a great article yesterday that they published about the feeling about the economy, that we're not at 9% inflation like we were 2 years ago, but 2019 prices were still way, way off, and we're not going to see that anytime soon. So there's this feeling that of frustration and just a sort of a so-so thing.
Yeah.
But, keeping in mind, the Fed has 2 mandates. So that means they're watching jobs figures very closely. And as the Fed chairman himself has indicated, there's been a market softening. They do not want any more of what we've seen in terms of layoffs to sort of metastasize into something that's much more dramatic, much more sort of widespread in terms of layoffs. Enough's enough there. Like, let's give the market a little bit of juice, but not so much that it overstimulates the economy all over again.
All right, sounds good. Javier David, thank you so much.
Sure.